So you're spending over $1 million a year just to, just to tread water. Like, really think about that for a second.
It's a brutal reality check, honestly.
Yeah.
But it's an absolutely necessary one.
Right, because $350 at a time, you are buying clients who are just mathematically guaranteed to blow up their accounts within 90 days.
Yeah, you're basically pouring acquisition capital into a funnel that, well, it leads directly to a graveyard of dead liquidity and server bottlenecks.
Exactly. So if you are a broker executive listening to this right now, welcome to the deep dive. Today, we are tearing down the retail casino.
We really are, because the legacy model of the retail brokerage, relying on churn and burn and that whole illusion of the lucky trader, it's just fundamentally broken.
Yeah, it starves the exact infrastructure it runs on. And that is the explicit mission of today's customized deep dive. We're calling this Algo Talk.
I like that.
Yeah, so we have this highly confidential 32-slide presentation deck sitting right in front of us. And we're going to dissect it slide by slide. I'll be reading the titles as we go so you can follow along.
And the title of this first one is really setting the tone.
Right. It's called Quantgate.co, Exposing Legacy Boards and Scaling True Broker Volume. And then the subtitle, which I think tells you everything you need to know about how serious this document is, it says Master Service Agreement and Joint Venture Architecture, Final Executive Review.
Yeah, that subtitle is just critical. I mean, this is not a theoretical white paper.
No, not at all.
It's not a shiny marketing brochure. It is a finalized blueprint for a structural joint venture.
Exactly.
By the time we finish this discussion, you, the listener, you're going to understand exactly why your current operations are bleeding capital. And more importantly, why adopting this institutional-grade AI-driven asset management hub is literally the only mathematical way to secure your future.
Yeah, we are talking about capturing millions in previously unrealized annualized volume.
Millions. It's wild.
So I want to dive straight into the deep end here. There is a slide early in this deck, slide 2, titled Current Retail Reality versus the Quantgate.co LLC Architecture. It paints this really stark, almost painful contrast.
It really does. It's the nightmare versus the cure.
Right. On the left side, it outlines the nightmare you are likely living right now. A 90-day churn cycle, blown accounts, bleeding CAC, which is your customer acquisition cost, and algorithms that are essentially a single point of failure.
And then you look at the right side, the architecture Quantgate proposes, it flips every single one of those liabilities into an asset.
Which is exactly what you want to see.
Right. So instead of a 90-day churn, you're looking at a 3+ year lifetime value for your clients.
Wow.
Yeah. And instead of blown accounts, you have systemic algorithmic hedging. Instead of bleeding acquisition costs, you get compounded spread generation.
And instead of those single points of failure, you're deploying multi-node AI swarms. But, let's break down the pain points first before we get to the cure, because the deck does a phenomenal job of diagnosing the disease.
Oh, absolutely.
So slide 3 is titled High Customer Acquisition Cost versus Dead Capital, the 90-day death spiral. And this one really hit me. It visualizes this funnel where money just literally turns to ash.
It's painful to look at, honestly.
It is.
Yeah.
Because you're spending, on average, $350 to acquire a single retail trader.
Which is a massive upfront expenditure for a broker. And what do you actually get for that $350?
Right.
The data on the slide shows a 90-day survival horizon. That means within 3 months, the vast majority of those newly acquired retail clients just hit a brick wall.
They over-leverage, the market moves against them, and boom, margin call.
Exactly. Their accounts blow up and they are just gone.
But the deck points out something even more insidious about the survivors, the ones who don't immediately lose everything. They fall into this pool that the presentation calls dead liquidity.
Yeah, dead liquidity. That is the silent killer of a brokerage treasury.
Walk me through that, because it sounds incredibly ominous for the bottom line.
It is. So let's say a client survives the first month, right? They're scared. They realize they don't actually know how to trade.
Shocker.
Right, so what do? They look at your platform's leaderboard and they find some one-trade wonder who got incredibly lucky. And they allocate their remaining capital to copy this person.
Okay, makes sense from their perspective.
But that gambler has stopped trading because they are terrified of losing their lucky gains. Or worse, they are trapped in a massive underwater position, just praying the market turns around.
So the client's capital is just parked there. It's sitting in the account, totally stagnant.
Exactly. For weeks or even months, That capital does absolutely nothing. And you have to remember how a brokerage actually makes money. It's the spread.
Right. You only generate revenue when volume is executed.
Precisely. If the client's capital is locked in a stagnant copy trade, yielding zero ongoing spread revenue, it is dead liquidity. You basically spent $350 to acquire a digital paperweight.
A digital paperweight. Man, that completely reframes the whole concept of the leaderboard. Because most brokers, they treat their leaderboard as their best marketing tool.
Oh, yeah. Look at this guy making 300%.
Right. But slide 4 is literally titled Exposing the Casino, and it explicitly tears down that illusion. It argues that legacy leaderboards mathematically push over-leveraged retail gamblers to the #1 spot.
Because the algorithm running those legacy leaderboards is profoundly flawed. It ranks traders by highest overall raw return.
Just raw percentage.
Yeah. So if a trader leverages their entire $5,000 account on a single wild guess on, say, the CPI data release, and it just happens to go their way, they might show a 500% gain.
And the legacy system sees that, assumes they're some kind of genius, and just rockets them to the top of the leaderboard for all your new clients to see.
Exactly. But wait, let me push back a little here. Let me put my broker executive hat on.
Okay, go for it.
Aren't high returns exactly what retail clients want to see? I mean, if a guy is boasting a 500% return, doesn't that attract more deposits to my platform? Why is that actually bad for my business?
Well, because of what is lurking just beneath the surface. Right?
Right.
If you look at the reality section of that same slide, it exposes the hidden data.
The telemetry truth.
Yes, these systems frequently hide massive, terrifying drawdowns. We are talking 900% plus unrealized drawdowns. The trader didn't execute a calculated, repeatable strategy. They basically survived a near margin call by pure blind luck.
They went to the roulette table and put everything on 00.
And won.
Ones. Precisely. And by putting that person at the top of your leaderboard, you are aggressively encouraging thousands of your newly acquired clients to blindly follow them.
It's a disaster waiting to happen.
So when that gambler inevitably goes back to the well, puts it all on 00 again, and misses, well, they don't just blow up their own account.
No, they take everyone with them.
They simultaneously vaporize the accounts of every single client copying them. The business impact, as the deck clearly states, is a 90% user churn within 90 days.
So you are literally marketing a ticking time bomb to your own user base.
You really are. The lifetime value of your client is destroyed before they ever generate meaningful spread for your treasury.
It's corporate self-sabotage. And
Yeah.
the deck actually names names here. Slide 5 is titled, Your Leaderboard is Starving Your Brokerage. It lists these false idols.
Yeah, those profiles are telling.
You have trader profiles like Naga_35 and Flufferoll Gold. They have these massive profit percentages in bright green and hundreds of copiers. But the slide reveals the telemetry truth.
This is where the unit economics completely collapse for the broker. Look at the actual execution volume. Our first top trader, Naga, executes a grand total of 3.36 lots per month.
Wow.
Yeah. The second top trader does 2.51 lots. And the third, despite having 1,600 followers, executes a microscopic 0.29 lots per month.
I actually did the math on this when I first read it, and it stopped me in my tracks. Because if that third trader is only executing 0.29 lots a month, and as a broker, you are making a net spread of, say, $15 a lot.
Right, standard spread.
You take 0.29 times 15, you are making $4.35 a month off your supposedly elite top-tier trader.
It's pathetic. It's worse than just low revenue, honestly. It's an active financial drain.
How so?
The slide points out that these gamblers cost you more in server database space just to host their profiles and route their sporadic signals than they ever contribute to your treasury.
So they are infrastructural parasites.
Exactly.
Which leads us directly into a massive operational headache outlined on slide 6, titled The One Trade Wonder Trap. It maps out this painfully familiar 4-month timeline.
Oh, this is the classic bottleneck scenario.
Right. Month 1, a lucky retail leader executes a single massive unhedged gamble.
Yeah.
Month 2, the trade sits open, generating 0 ongoing commission. Month 3, still nothing. And then in month 4, an alarm goes off. Server bottleneck detected. What exactly is happening under the hood there?
It is an infrastructural nightmare caused by latency. Let's say this one trade wonder finally decides to close their massive gamble. Or maybe they suddenly open a new, highly leveraged position after 4 months of total silence.
Right.
Your server suddenly has to execute that exact signal for the thousands of people copying them all at the exact same millisecond.
It's like 1,000 people trying to sprint through a single revolving door at the exact same moment.
That is a perfect analogy. The system simply cannot handle the simultaneous request load. So the copy trade latency causes severe bottlenecks.
And that ruins the trade for the followers.
Because of the delay, the trading edge degrades instantly through slippage. By the time the server processes the trade for the 500th copier, the market price has moved significantly against them.
So the clients get terrible fills, they lose money, they get furious, and they leave your platform.
Meanwhile, you are bleeding capital trying to upgrade servers to handle these unpredictable, massive spikes in routing traffic.
It is chaos. Just muddy, unpredictable, unprofitable chaos. So the legacy casino model is thoroughly exposed. We see the leaky bucket. How do we actually fix it?
This is where we get into the good stuff.
Right. This brings us to section 2 of the presentation.
Huh.
And slide 11 here really serves as the pivot point. It's titled The Systematic Swarm Revolution, with the subtitle, The End of the Single Point of Failure.
This is where Quantgate transitions from diagnosing the critical failures of the industry to administering the architectural cure.
And the visual on this slide is really fascinating. It shows a central master node at the top, and it branches down, connecting to 12 distinct subnodes labeled node 01 through node 12. Walk me through what I'm looking at.
You are looking at the core of the Quantgate ecosystem. Instead of relying on one emotional human making a lucky guess, Quantgate deploys rolling multi-node AI swarms.
Okay, AI swarms.
Yeah. These are not simple algorithms. A swarm consists of 12 to 20 highly profitable, entirely non-correlated robots working in unison.
Wow, 20 bots in one swarm.
Right. And they trade mathematically appropriate lot sizes, engineered specifically for low drawdowns and continuous high-frequency execution.
Now, here's a concept from the deck that I want to spend some real time on, because it feels almost counterintuitive at first glance, but the presentation frames it as an absolute non-negotiable rule.
I know what you're going to say.
Yeah, a swarm only trades one instrument, singular focus.
Yes. It is the foundational law of this architecture. If you want to understand how artificial intelligence actually achieves an institutional edge, you have to understand the necessity of extreme specialization.
So as a broker, I can deploy many different swarms simultaneously, but internally, a single swarm is hyper-focused.
Exactly. The gold swarm only contains robots that trade gold, period.
The deck lists a few others here. The YenNinja swarm only trades the USD-JPY pair. The US30 swarm exclusively trades the US30 index. But why not just have one super smart AI that scans the entire market and trades whatever looks good?
Because an AI attempting to be a master of everything becomes a master of nothing. Think about the microstructure of different assets. Gold does not behave like the Japanese yen.
Oh, for sure.
Gold reacts to inflation data, geopolitical panic, and bond yields. The yen reacts to Bank of Japan rate tweaks and export data. The US 30 index has entirely different volatility patterns, driven by corporate earnings and tech sector momentum.
They have completely different personalities.
Exactly. The order book dynamics, the tick-by-tick momentum, the way liquidity pools form and evaporate, they are unique to the asset.
So the AI needs to specialize.
By isolating a 20-robot swarm to a single instrument, you allow the machine learning algorithms to perfectly map the specific micro-behavior of that one asset.
That makes total sense.
The AI learns the subtle, repetitive inefficiencies that occur only in gold or only in the yen. It's the difference between hiring a team of 20 elite cardiologists to operate on a heart versus asking a general practitioner to simultaneously perform open-heart surgery, fix a broken ankle, and diagnose a lung disease. You need specialized precision.
I love that analogy. And from a brokerage operations standpoint, this singular focus provides an incredible marketing cadence.
Oh, it really does.
Look at slide 12, titled The Monthly Deployment Engine. It maps out a rollout schedule. Month 1, you launch the YenNinja swarm. Month 2, the US 30 swarm goes live. Month 3, Euroslayer. Month 4, the gold swarm.
This completely solves the customer reactivation problem.
All right, because in the legacy model, your marketing emails just say, hey, come back and trade.
Which is completely uninspiring.
Yeah. But with the swarm architecture, every single month, a new, highly specialized institutional-grade portfolio comes online exclusively on your servers.
It gives you a continuous, compelling narrative. You can say, the new Euroslayer AI is now live. Reactivate your account to gain access. It constantly compounds your marketing hooks and reactivates dormant capital.
But the marketing only works if the performance is real. Let's look at the actual data. Slide 7 is titled Real Traded Data, 1, 3, 5, and 7 years back. It introduces the Elite Gold Swarm, which it calls the defensive masterpiece, and the US 100 Swarm, labeled the Active Exposure Engine.
The metrics here are almost hard to believe.
They really are. Elite Gold boasts a verified live Sharpe ratio of 14.98. Let's ground that for a second. A Sharpe ratio measures risk-adjusted return, right?
Yes. It tells you how much risk the system took to achieve its profit. Most hedge funds are thrilled with a Sharpe ratio of 2 or 3.
So 14.98 is astronomical.
It implies a practically vertical equity curve with microscopic drawdowns, and the deck explains how it achieves this through a 10-bot optimization process focused purely on capital preservation.
Wow.
Yeah, it's designed to weather the most violent commodity storms without exposing the principal to significant risk.
And then on the aggressive side, the US 100 Swarm shows a positive 146.08% verified live growth with an 8.24 Sharpe ratio.
Which is just incredible.
And it says this is achieved through dynamic equity index exposure with segregated nodes.
The term segregated nodes is the secret to that stability. If one robot within the 20-bot US 100 swarm catches a bad tick or gets caught on the wrong side of a sudden microtrend, the other 19 robots are executing entirely different logic models.
So they balance each other out.
Often they're actively hedging that exact exposure. The variance is instantly flattened out across the swarm.
Let's drill down into the telemetry of those wins, because slides 8 and 9 show these beautiful dark mode dashboards with the internal stats. The Elite Gold Swarm shows an 82% win rate, 94 trades won, 21 lost.
Right.
The US 100 Swarm shows an 81% win rate, 136 won, 32 lost.
What's fascinating here is the underlying engine driving those numbers. We have to confront a fundamental truth here. AI is exponentially smarter than human traders.
Oh, absolutely. I mean, watching a retail trader try to draw a Fibonacci retracement line on a 1-minute chart while chugging a Red Bull, it's not exactly high-level quantitative analysis.
It's guesswork driven by emotion, fatigue, and profound cognitive bias. The Quantgate AI isn't just a basic set of if this then that rules. We're talking about deep, sophisticated retraining over years of live, real money execution.
In the presentation notes, they utilized Google machine learning frameworks to process market telemetry.
Exactly. And they are doing it in milliseconds. Before a human has even blinked, the AI has analyzed 1,000 ticks of data across the order book.
It's operating on a completely different level.
It calculates probability, spread margins, latency slippage, and historical asset correlation before a human could even move their mouse toward the buy button. It operates in a cognitive dimension that humans simply cannot access.
And this leads to my favorite slide in this section, slide 27. It's titled The Unassailable Moat, Battle-Tested Telemetry. It's a timeline graph mapping the AI's performance through massive, chaotic global events.
This is a big deal.
It specifically highlights how the algorithms navigated the 2020 COVID crash, where global liquidity evaporated overnight, and the 2022 to 2023 rate hike cycles, which introduced a totally different, grinding volatility regime.
This is the critical difference between theoretical backtesting and live production. In the algorithmic space, competitors constantly peddle overfitted backtests.
Right.
They take historical data from quiet, highly predictable market conditions, and they mathematically tweak their bot until it looks flawless in the past.
So they build a ship that sails perfectly on a glass calm lake.
Exactly. But the second you take that overfitted bot and plug it into a live market shock, like a pandemic or a surprise central bank rate hike, the ship instantly sinks.
Yo.
The algorithm encounters conditions it wasn't hard-coded for, and it blows up the account. Quantgate provides the broker with nearly a decade of institutional research forged in the actual fire of live execution.
Which brings us to the summary slide of this section, slide 13, the 3 to 7 year battle-tested moat. It lists 3 pillars. First, 7 years of live production execution. Second, 99.9% uptime.
Let's pause on that uptime metric. That 99.9% is achieved via proprietary Web to MT5 routing sockets.
Okay, routing sockets.
Remember the server bottlenecks we discussed? The one trade wonder crashing your infrastructure because everyone tried to exit the revolving door at the same time?
Right, the latency nightmare.
Quantgate built their architecture specifically to handle institutional-level bottlenecks. The routing sockets are designed so that even when a swarm executes a complex multi-node hedging strategy across thousands of follower accounts simultaneously, the broker's infrastructure holds completely steady.
The trades execute without degrading the edge.
Exactly.
And the third pillar on this slide is perhaps the most important for the executive listening. $0 R&D risk for the broker.
Zero.
You are getting nearly a decade of quantitative research, institutional machine learning, and battle-tested execution algorithms without spending a single dime on software development or quant salaries.
So if we recap our position here, we have removed the high-churn gamblers. We have introduced highly focused, single-asset AI swarms. They trade frequently, they hedge automatically, and they have survived the worst macroeconomic shocks of the last decade.
But listener, I know what you are thinking. I know what your skepticism is screaming right now because my scam radar went off like an air raid siren when I hit section 3 of this deck.
Oh, I know exactly what you're talking about.
Yeah, we're moving into this section titled Achieving the Impossible, and I want to look at slide 17, the 124 strategy arsenal.
This slide visualizes the sheer breadth of the ecosystem. It is a live, decentralized marketplace of quantitative logic models, backed by up to 7 years of data, covering indices, forex, commodities, and crypto.
It's massive. And slide 18, algorithmic taxonomy, the asset allocation tiers, breaks down how they organize this massive arsenal. They divide it into 3 tiers.
Right.
Tier 2 is the high consistency sector, sitting at a 90% to 99% win rate. Tier 3 is the Genesis boundary, locked at 96.3% is an exclusive tier. We'll get to the Genesis log shortly, but I have to stop the entire conversation at Tier 1.
Here we go.
Yeah. Slide 19, flawless execution, the 100% win rate snipers. Okay, let's unpack this. A 100% win rate in trading.
It sounds crazy.
Listener, if you're a broker, your scam radar just went off. How is this actually mathematically possible without the bot eventually holding a losing position until the entire account goes up in flames?
It is the most justified skepticism a broker can have. When you see 100%, you assume fraud.
Right.
But to understand how Quantgate achieves this, we have to fundamentally divorce our thinking from the way humans trade. A 100% win rate is obtainable, but only by finding an absolute structural mathematical advantage.
Explain that. What does a structural mathematical advantage actually look like in a live market?
It relies on identifying a highly calculated, highly probable outcome, and then possessing the discipline to execute only when that exact mathematical pattern presents itself.
And humans just don't have that discipline.
No, a human trader gets bored, they wait 2 hours for a setup, it doesn't happen, so they force a mediocre trade just to feel active.
We've all been there.
The AI does not feel boredom. It will wait for days, scanning millions of ticks, until the probability aligns perfectly.
Let's ground this in the specific examples on the slide. It highlights an AI bot called BOMO_E20. The stats read, 0 losses over 12,256 days.
Think about that.
That's 3.5 years without realizing a single loss. The slide says its core mechanic is that it refuses to realize losses. It utilizes scaling and complex hedging to wait out momentary pricing lags until statistical reversion to the mean occurs.
Reversion to the mean is the foundational concept here. Think of market pricing like a massive heavy suspension bridge.
Okay.
When a severe gust of wind hits, like a sudden market shock, the bridge doesn't snap, it bends. The wind pushes it off center. Statistically, mathematically, the laws of physics dictate that the bridge must return to its center of gravity.
I follow the analogy. So how does BOMO_E20 trade the bridge?
The AI identifies when the market bridge has been pushed so far off center that a snapback is a mathematical near certainty. It enters the trade. Now, if the wind blows a tiny bit harder and pushes the market slightly further against the position, a human retail trader panics. They hit their stop loss, take a painful hit, and step away.
And then they watch in agony as the market immediately reverses in the exact direction they originally predicted.
The classic retail tragedy.
Yep.
But BOMO_E20 does not panic. When the market moves against it, it engages dynamic scaling and institutional hedging, much like the tension cables on the suspension bridge distributing the weight.
Oh, wow.
It absorbs that momentary lag, secures the position using precise equity risk calculations, and simply waits. It waits for the wind to die down. When the inevitable statistical snapback occurs, the mean reversion happens, and the bot closes the trade in profit.
It mechanically refuses to close the trade in the red.
Exactly. And because it's an AI, it has no ego. It just executes the math of the tension cables.
The second bot highlighted here is called Euro_Catcher. Same stats, 1,256 days validated, 0 losses. But its mechanics are different. It says it exploits micro-inefficiencies in the EUR order book with surgical precision.
Right.
What is a micro-inefficiency?
It's a fleeting imbalance in the market's plumbing. Imagine the order book as a giant ledger of everyone waiting to buy and sell.
Yeah.
Suddenly, a massive institutional player dumps a huge order into the euro.
Okay.
For a fraction of a second, the bid-ask spread fractures. There is a micro imbalance between the buyers and sellers that shouldn't mathematically exist.
It's a pricing error in the matrix.
Exactly. A human can't even see it happen.
Yeah.
But Euro_Catcher's AI, processing order flow in milliseconds, spots the imbalance before the wider market maker algorithms can adjust.
And it pounces.
It slips in, captures 2 or 3 pips of guaranteed, risk-free inefficiency, and exits the market. It is entirely surgical.
But if these bots only trade when conditions are mathematically perfect, they clearly aren't trading every 5 minutes. A broker needs continuous volume to generate spread. That's where slide 20 comes in. Deep endurance, the high consistency sector.
This is the brilliant synergy of the portfolio architecture. The 100% snipers are the scalpel. They wait in the weeds for the perfect strike, but you need an engine to drive daily volume.
And the slide highlights an algorithm named FastDE406X8, which trades the DAX index. It boasts a 96.1% win rate over 2,562 validated days.
The DAX index is incredibly volatile. A sniper bot might sit out the DAX for days, but these high-consistency bots are high-frequency momentum engines. They execute relentlessly.
So they keep the volume pumping.
Yeah, they might take a small, highly calculated loss 3.9% of the time, but their sheer frequency of execution allows them to grind through massive macroeconomic regime changes. They survive black swans while continuously generating massive spread volume for your treasury.
So we have the technology. We have the absolute mathematical advantage of the snipers, the high-frequency engines of the DAX bots, and the singular focus of the asset swarms.
It's undeniably institutional grade.
But as a broker executive listening to this, my next question is entirely logistical. How do I actually get my clients to use this? If I have to spend another $1 million in Facebook ads to explain AI mean reversion to retail traders, I'm out.
Oh, definitely. And that is the genius of Section 4, liquid engineering, and the wealth mechanics. This is where the business model truly clicks into place, and it solves the acquisition cost problem instantly.
Let's turn to slide 16. Zero-cost capital reactivation via VIP vouchers. This is exactly what a broker wants to hear. Walk me through the mechanics of this.
It's brilliant in its simplicity.
The slide notes that 50 wholesale seats are weaponized as cryptographic activation codes to awaken dormant high-net-worth individuals.
Let's define a dormant high-net-worth individual, or HNWI, in the context of your brokerage. Every platform has them. These are clients who deposited $10,000, $50,000, maybe $100,000.
Right.
They traded actively for a while, maybe they got burned by a bad signal, or maybe they just got busy running their actual businesses.
So the money is just sitting there, doing nothing. Dead liquidity.
Exactly. It isn't generating a single cent of spread. So Quantgate provides you, the broker, with 50 cryptographic activation codes. You don't run a Facebook ad. You have your account managers personally call your top 50 dormant whales.
A personal touch.
You tell them, as a valued client, we are granting you exclusive, complimentary VIP access to our new institutional AI asset management terminal.
The psychological hook is exclusivity.
Absolutely.
And the business impact listed on the slide is immediate. The customer acquisition cost is $0. By handing out 50 seats to clients required to have a minimum $10,000 balance, you instantly generate $500,000 in active copying AUM on day one, with zero marketing burn.
You reanimate $500,000 of dead capital with a phone call.
But what do these VIPs actually do once they get the code? Because they don't just want to hit a copy button like a standard retail user.
No, they want control.
This is detailed on slide 21, Custom Diversified Sandboxing, the 5-robot VIP limit.
This taps into the psychology of wealth. High net worth clients want to feel like architects of their own capital. They want agency. They consider themselves sophisticated, so they want to tinker and engineer a system.
This slide shows them getting a private VIP MP5 terminal. From there, they are allowed to select up to 5 distinct non-Genesis robots to combine into a custom portfolio.
Right.
And, keeping with the philosophy we discussed earlier, they are encouraged to combine bots across fundamentally different asset classes to hedge their macro exposure. The diagram shows a VIP selecting a gold bot from commodities, a DAX bot from major indices, EUR-JPY from Forex, and U.S. oil.
They are essentially building their own multi-node institutional-grade portfolios. This creates incredibly high retention and satisfaction for the VIP.
They feel invested in the process.
Exactly. They have the controls, they are using elite AI, and they are likely seeing fantastic, stable equity growth.
Well, wait, I noticed something crucial here. The slide says they can combine up to 5 non-Genesis robots, and slide 22 is entirely dedicated to this restriction.
Yeah.
It's titled The Genesis Boundary, protecting the moat. And it features a massive blue padlock icon sitting right between the VIP sandbox and the public leaderboard. Why are we locking our best, richest clients out of certain algorithms?
This is known as the strategic lock, and it is the single most vital defensive mechanism in this entire joint venture. Yes, the VIPs get to combine up to 5 standard robots. However, they are strictly blocked from accessing Genesis-exclusive algorithms.
Like that 100% sniper bot, BOMO_E20, or those other elite bots.
Precisely. And here's why that is absolutely critical. Quantgate's proprietary master swarms, those massive 20 robot portfolios that are placed on the broker's public leaderboard for the retail masses to follow, contain those Genesis-exclusive bots.
Okay, I'm following.
By strictly limiting the VIPs to 5 standard bots, it becomes mathematically impossible for a VIP to ever replicate the performance or the risk-adjusted stability of the 20-bot master swarm.
Let me make sure I'm connecting the dots here.
Yeah.
If a VIP could replicate the 20-bot master swarm on their private account, they might decide to go rogue.
They absolutely would.
They might start broadcasting their own copy trading signals to the public, undercutting the brokerage. Or they just hoard the best performance in private, giving the public nothing to follow.
Exactly. You would create volume fragmentation. By enforcing the Genesis boundary, the absolute best, most highly tuned, most risk-averse swarms remain exclusively on the broker's public leaderboard.
So the VIPs get a great tool, but the house keeps the ultimate weapon.
You got it.
This logic flows perfectly into the alchemy outlined on slides 23 and 24. Engineered for broker spread revenue, and absolute restriction creates absolute abundance.
These are the money slides.
I want to trace the diagram of liquid engineering shown here. It's a literal funnel of wealth generation. It starts with the high net worth capital flowing into the VIP sandbox. We established that this creates high satisfaction for the whales. But how does that help the broker with the rest of their user base?
Well, the VIPs are the spark. They win first. Their accounts are growing steadily with low drawdowns. Because they are highly successful, this acts as a massive organic marketing magnet within your community. Word gets out.
People talk.
The retail masses on your platform see that the smart money is winning using these AI systems.
But the retail guys with $300 in their account, they don't have the $10,000 required for a VIP seat, so where do they go?
We intentionally force that mass retail liquidity directly into the broker-controlled 20-bot master swarms on the public leaderboard. The VIPs prove the concept, but the master swarm is the engine.
Wow.
The retail masses have no choice but to follow the master swarms. More followers copying the master swarms means exponential lot execution. The slide visualizes this funneling down to generate over $600,000 in monthly spread generation.
That is the alchemy right there. You satisfy the whales with restricted tools, which forces the retail army into the public swarms that you fully control. And as the slide emphasizes, by hard-locking retail workarounds, you concentrate all this unparalleled trading volume entirely within your proprietary ecosystem. Absolute restriction of the technology creates absolute abundance of spread volume.
And to complete this total transition, we look at slide 31, restructuring for profitability. You have this massive AI engine ready, you have the VIPs activated, but you have to clear the old casino floor first.
Right.
The broker must flip the algorithmic switch on their public leaderboard.
The slide visualizes a toggle switch moving from legacy to Quantgate. On the legacy side, it literally crosses out ranking by reckless gambling, which ranked by raw percentage gain.
Good riddance.
Yeah, and on the Quantgate side, it introduces ranking by risk-adjusted consistency. Metric number 1, Sharpe ratio. Metric number 2, trade count per month. Metric number 3, lowest drawdown.
By simply changing the criteria of how the leaderboard ranks traders, the new algorithm instantly overrides the old board. Those inactive, 0.29 lot gamblers we talked about in the beginning, they instantly fall to page 50 where no one will ever see them again. And it forces these high-volume, highly consistent, automated institutional swarms straight to the top, right in front of the retail masses. The casino is closed. The asset management hub is open.
Okay, we are moving into section 5. The machine is built, the psychology of the VIPs is set, the leaderboard is flipped. But in the world of financial brokerage, cutting-edge technology is only as valuable as its security.
Security is everything.
We are looking at slide 10, eliminating client churn and securing the moat, and slide 14, Quantgate enterprise architecture. The burning question for any executive is, how secure is this setup? What stops a rogue VIP client or a direct competitor from reverse engineering these AI algorithms once they're loaded onto a terminal?
That brings us to slide 25, technical enforcement, the MT5 trade locker server lock. This is where the physical cryptographic security of the intellectual property is strictly enforced.
I am reading the flowchart on this slide. It details the process when a VIP activates their gifted seat. The compiled expert advisor file, the EA bot itself, runs an immediate terminal query. It reads the live server name of the specific account it is attached to.
Right. The compiled code inside the algorithm is hard-coded to whitelist strictly your brokerage's specific server signature. If it queries the terminal and detects a perfect match with your partnered server, execution is fully granted. The AI begins scanning the order book.
But if someone somehow extracts that EA file and tries to load it onto a competitor's platform, or a rogue, unrecognized private terminal?
The flowchart shows a hard red path. Competitor unrecognized terminal leads to routing error, execution frozen. It provides total IP protection.
That's incredible.
The bots physically cannot execute logic, pull data, or trigger trades anywhere except within your specific partnered brokerage ecosystem. It protects the scarcity and the absolute enterprise value of the algorithms.
Brilliant. A true walled garden. Now let's get back to the math, because at the end of the day, you are listening to this deep dive because you want to know exactly how this scales your volume.
Show me the money.
Right. Slide 28 outlines the systematic volume through institutional swarm architecture, showing the flow from the non-correlated bots through the AI hedging processor direct to MT5 routing. We understand the flow. Let's look at the actual mathematical output on slide 29. What real US 100 swarm volume looks like.
For a broker executive, this is the most important math you will look at all year. This is where the compounding leverage of the swarm becomes visceral.
I'm going to walk through this step by step, conversationally, because the sheer scale of the numbers requires it.
Please do.
Step 1. We have a master account running the active US 100 swarm with a $10,000 base balance. Over just 9 active trading days, it executes 136 trades. Because it's an active momentum engine, that totals 696.15 lots executed.
Now, in the legacy casino model, a single guy does 600 lots, you make a little spread revenue, and then he blows up. End of story. But remember the multiplier effect of the institutional swarm.
Step 2 applies that multiplier. You take that master account volume and multiply it by a copy pool of just 50 qualified VIP followers. And remember, the non-negotiable rule is that those VIPs are required to have a matching $10,000 base to follow this swarm.
Right, so it's a perfect 1-to-1 lot ratio. You take those 696.15 lots generated by the master AI and multiply it across the 50 followers.
The result is a generated ecosystem volume of 34,807.50 lots.
In 9 days.
In 9 days. And here's the grand finale at the bottom of the slide.
Yeah.
Broker gross spread revenue. Assuming a standard net spread of $15 per lot. You take 34,807.50 lots times $15. The broker just made $522,112.50 in pure, highly liquid spread commissions in just 9 days.
$500,000.
$500,000.
And that is just one single swarm, the US 100, running on 50 VIP accounts.
It fundamentally changes the unit economics of the brokerage. But let's look at the conservative side. Slide 30, conservative wealth compounding, elite gold swarm performance. This is meant to be the defensive masterpiece, correct? It's not trading aggressively, it's preserving capital.
Correct. The trading frequency is much lower, so the volume numbers scale differently, but the underlying compounding mechanic is identical.
The slide shows a master account for the gold swarm with only a $5,000 base. Over an active time frame of 30 trading days, so roughly 6 weeks, it executes 129 closed trades, totaling 46.37 lots.
Now apply the multiplier. You still have your 50 VIP followers, but remember, the followers have a mandatory $10,000 balance. Since the master is only trading on a 5,000 DES, the copy system automatically applies a 2.0x mathematical multiplier to properly scale the lot sizes to the followers' larger equity pool.
Ah, I see. So you take 50 followers, multiply with a 2.0 scaling factor, and multiply that by the 46.37 lots. The generated ecosystem volume is 4,637 lots. Multiply that by your $15 spread, and that is $69,555 in pure spread commissions in 6 weeks.
And as the slide explicitly points out at the bottom, even under the most conservative, highly defensive commodity hedging swarm, just reactivating 50 dormant VIP clients yields more spread revenue in 6 weeks than an entire leaderboard of standard retail traders desperately trying to guess the direction of gold.
Which brings us to the ultimate reality check of this entire presentation. Slide 26, 1-year projections, the cost of inaction. We've seen the staggering leverage when you turn the engine on. Now let's look at what happens if you close this deck, ignore the architecture, and do nothing.
The slide presents the two realities side by side. On the left, without this integration, continuing legacy operations.
It lists the painful statistics we started with. A 90% client churn, a 90-day average lifetime value, and the brutal reality of wasted capital. The projection estimates you will continue leaking approximately $1.26 million a year in customer acquisition costs just to replace the accounts that are mathematically guaranteed to blow up on your casino floor.
It's just burning money.
You are spending over $1 million just to keep the lights on and the leaderboard populated with false idols.
And on the right side, with systematic swarms. Assuming a very conservative, entirely organic scaling rate of adding just 5 new retail followers per swarm per week, by the end of year 1, you project 1,688 active copying clients.
Those 1,688 clients feeding off the continuous high-frequency execution of the AI bots generate an estimated total volume of 402,149 lots in year 1, and the gross spread calculation at the bottom, $6.03 million.
The Quantgate model captures over $6 million in previously unrealized, highly stable annualized volume. That is the true cost of inaction. Every single day you delay signing this agreement, you are actively choosing to leak acquisition capital instead of capturing guaranteed AI-driven volume.
Okay, we are in the home stretch, the outro, the final 3 slides of the deck. You see the undeniable math, you see the institutional tech, you see the cryptographic security. How do you actually finalize this joint venture? Section 6 outlines the agreement. Slide 32 is titled The Executive Professional Tier.
This lays out the exact business arrangement. It is incredibly straightforward, without any convoluted hidden fee structures.
The slide shows the brokerage treasury on the left and Quantgate LLC on the right. Step 1, Quantgate delivers the 50 VIP sandbox codes we talked about, unlocking those non-Genesis bots for your high-net-worth clients to immediately reactivate that dead liquidity. Step 2, the broker pays a $20,000 upfront monthly software fee per swarm.
Now, a $20,000 monthly line item sounds significant until you put it into the context of the mathematical leverage we just spent the last hour discussing.
Right, because Step 3 is what matters. The broker retains 100% of the remaining spread commissions indefinitely. As it says right at the bottom, the swarm's base trading volume easily eclipses the licensing fee in week 1. If the US 100 swarm is generating $522,000 in 9 days, a $20,000 monthly fee isn't an expense, it's a rounding error on an exponential profit engine.
However, Quantgate is handing over an engine that generates millions, so it does not come without strict structural rules to protect the integrity of the ecosystem. This is outlined on slide 33. The ironclad joint venture are non-negotiables.
The title literally says, we are handing you the engine to generate $500,000 to $2 million a month in pure spread revenue. In exchange, the Quantgate ecosystem operates under 3 absolute non-negotiable mandates. Break these down for me.
I am going to read these rules directly to you, the listener, because they define the operational reality of this partnership. Term 1 is the liquidity mandate. To retain their complimentary VIP access, every one of those 50 high-net-worth clients must actively follow a Quantgate master leaderboard with a minimum base of $10,000.
Okay.
The impact here is that Quantgate secures an instant, guaranteed $500,000 in baseline copying AUM on day 1. It is contractually enforced. You don't have to market for liquidity. It is structurally built into the VIP requirement.
Understood. Term 2 is the IP lock, subtitled No Commercial Cannibalization. We touched on this with the Genesis boundary lock. VIPs are strictly locked to the retail terminal. They can build their custom portfolios, but they are technologically prohibited from broadcasting those strategies or building their own copy trading rosters.
The impact here is an absolute monopoly. Quantgate's 20-bot master swarms remain the only institutional signals available to the retail masses on your platform. We feed your brokerage massive, continuous volume, and your VIPs are structurally prevented from competing with us for followers.
And the final rule, Term 3, the institutional double dip. Quantgate extracts a minimum 10% revenue share of every spread fee linked specifically to our copy trading, plus a standard 20% weekly performance fee on all generated follower gains.
The impact is beautifully simple. We get paid for the volume we generate for the house, and we get paid for the performance we deliver to the client. The house wins, the client wins, and Quantgate wins.
Which brings us to the final slide of this presentation, slide 34. The title says it all, Secure Your Leaderboard. Below that, glowing like a command prompt, it just says, Initiate Swarm.
The retail casino boards are dying. The model of hoping a gambler gets lucky long enough for you to harvest a few dollars in spread is mathematically defunct. Systematic algorithmic trading is the only mathematical way to stabilize and compound broker revenue.
Let's sort your algorithm, load the first swarm, and awaken your dormant capital. Your VIPs win first, that brings the followers, and that secures your spread revenue forever. The future of your brokerage is institutional, and the transition starts today. Stop bleeding your acquisition budget into a muddy casino. Sign the MSA, implement the architecture, and let's start engineering real volume. Thank you for joining us on this Algo Talk Deep Dive. Execute the swarm, and we will see you next time.